In recent weeks, an event has been unfolding in global financial markets that at first glance may seem technical, but in reality is capable of changing the entire architecture of the global economy. China has begun rapidly reducing its holdings of US government bonds while simultaneously increasing its gold reserves, bringing them to historical highs. According to international financial agencies, the volume of treasuries on China's balance sheet has fallen to about $680 billion, the lowest level in the past 18 years. At the same time, China's gold reserves have risen to record levels, around 74 million ounces, and this growth continues. In financial terms, this looks like a deliberate and systemic pivot rather than a one-off portfolio adjustment. China is, in essence, gradually exiting dollar dependence and shifting its reserves into an asset that is not controlled by any single state and cannot be frozen by sanctions. Experts note that this decision cannot be viewed in isolation from geopolitics. Against the backdrop of escalation between the US and Europe, a crisis of trust within NATO, sanctions wars, and precedents of force-based pressure on trade and shipping, Beijing is drawing conclusions. The dollar and US bonds, which for decades were considered risk-free assets, are no longer seen by China as neutral stores of value. In Beijing, it is well understood that in a world where the financial system is increasingly used as a weapon, holding trillions in instruments controlled by a potential adversary becomes a strategic risk. That is why China is acting not abruptly, but methodically. It is not crashing the market with a one-time sell-off, but consistently reducing its share of US debt and replacing it with gold, a physical asset that cannot be blocked or nullified by a political decision. What particularly worries analysts is that China may not be the only player moving down this path. If Beijing continues this strategy, other countries in the region, from Southeast Asia to the Middle East, may well follow suit, especially those states that are closely watching how sanctions and asset freezes are used against undesirable regimes. In such a scenario, we could see a chain reaction in which demand for US bonds begins to decline not sporadically, but systemically. This would pose a direct threat to the entire model of US debt financing, which for decades has rested on trust and global demand. Against the backdrop of US-EU tensions, trade wars, and conflicts over resources and logistics, such a shift could become a catalyst for a far more large-scale crisis. Experts warn that if several major holders of treasuries begin cutting positions simultaneously, this could trigger rising yields, higher costs of servicing US debt, and turbulence across all global markets. Ultimately, not only America, but the entire dollar-centric global financial system would be hit. That is why many today describe what is happening not simply as a financial maneuver by China, but as the beginning of a quiet de-dollarization of the world. This is not a loud collapse or an abrupt rejection, but a slow and almost imperceptible process that accumulates impact over time. Gold plays a key role in this scheme, acting as an anchor of trust in a world where political risks are becoming more important than economic indicators. And if current trends persist, we may find ourselves on the threshold of a new debt era, where old rules no longer work and familiar safe assets cease to be universal. The question now is not whether a global financial crisis will begin, but what will become its trigger, and whether the sell-off of US debt will be the moment when the system built after World War II finally begins to crumble. Against this backdrop, more and more economists and strategists are beginning to say that China's actions should not be viewed as an emotional reaction or a temporary measure, but as part of a long-term strategy that has been forming for years and has now simply entered its active phase. Beijing understands perfectly well that a sharp collapse of the US Treasury market would hit China itself, which is why it is acting with maximum caution, spreading sales over time and disguising them as routine reserve management. However, the overall direction is obvious. China is consistently reducing its vulnerability to US financial instruments. In this scheme, gold is not merely a defensive asset but a symbol of a transition to a new reserve model in which physical value, rather than paper claims, plays the key role. Analysts note that in conditions where assets can be frozen by a single political decision, gold becomes the last universal instrument of trust. A particularly alarming signal for markets is that these steps by Beijing are taking place against the backdrop of a rising US debt burden, which is already approaching levels that raise questions even among traditionally loyal investors. The higher the debt, the stronger Washington's dependence on external demand for its bonds, and it is precisely here that the reduction of Chinese participation acquires systemic importance. If China previously acted as a stabilizing factor in the treasuries market, it is now gradually stepping out of this role, shifting responsibility onto domestic U.S. demand and other foreign holders. Experts warn that at some point this balance may be disrupted, forcing the Federal Reserve to choose between higher yields and a new round of money printing. Both scenarios carry serious risks, either for the U.S. budget or for inflation and confidence in the dollar. Additional tension comes from the fact that de-dollarization no longer looks like a marginal idea. More and more countries are beginning to view it as an element of national security, especially after precedents of using the financial system as a weapon. In this sense, China is not a pioneer but a leader of the process, closely watched by other players. If even some of them begin to replicate the Chinese model, the world will face a slow but inevitable redistribution of financial power. This will not look like a sudden collapse, but its consequences will be far deeper than any short-term crisis. In such a world, the role of the dollar will gradually transform from an unconditional anchor into one of several regional instruments, signaling the end of an era that has shaped the global economy for recent decades. That is why what is happening today attracts such close attention. China is making no loud statements and declaring no financial war, but its actions speak louder than any words. And if this trend persists, future historians will likely point to this period as the moment when a quiet but decisive shift in the global financial system began, the effects of which will be felt for many years to come. This is precisely the main defining feature of the current moment. Changes are not occurring at the level of loud decisions or official doctrines, but in the realm of quiet, almost routine actions that over time add up to an irreversible trend. While markets argue about short-term yield fluctuations and the latest Federal Reserve statements, the foundation of the global financial system is slowly but steadily shifting. China is effectively testing a new reality in which reserves no longer have to be tied to a single currency or a single country, and stability is achieved through diversification and physical value. For the global economy, this means growing fragmentation, financial blocks, regional settlement systems, and alternative stores of value. And although the dollar will continue to play a key role for a long time, its status as an uncontested center of power is gradually eroding. The longer geopolitical instability persists, the faster this process will gain momentum. Ultimately, the world may move toward a system in which trust is no longer global but selective, dependent on political alliances, asset security, and the ability to protect one's own reserves. In this context, China's actions look not like a trigger for an immediate crisis, but like preparation for a world in which crises become regular. Beijing is not rushing, but it is not retreating either, carefully restructuring the financial foundation for a long game. And the further this process advances, the clearer it becomes that there will be no return to the previous model. A system based on unconditional trust in the dollar and U.S. debt is slowly fading into the past, giving way to a tougher, more pragmatic and fragmented financial reality in which every major player is forced to rely primarily on itself.